My name is Yinka Adelekan. I work for Agusto & Co. I'm the Group Managing Director of Agusto & Co. What has been the plan of Agusto & Co? Our plan is to diversify geographically. And why have we done that? We've seen that there has been a success. For instance, we introduced the concept of ratings into Nigeria. And we've seen that our business model in terms of ratings, in terms of research, in terms of training has been very good to the financial market. And so what we thought about is to replicate in other markets, and we saw the opportunities in Rwanda and in Kenya. So we came and sought the license, and we're licensed by the Rwandan Securities and Exchange Commission, and we're also licensed by the Kenyan Capital Market Authority. What are the opportunities that we see in Kenya, for instance? We think that if you look at the business of credit ratings, we believe that it's about time that you have a deep debt market whereby corporates can come and raise money on their own financial standing. So there's no dependency on the banking sector. The banking sector complements, but an economy should not depend solely on the banking sector. And we've seen it, that when there are credit ratings, investors are able to price risk appropriately, and therefore they're able to invest. And what this does is to deepen the debt market. And personally, I believe that there's a huge opportunity for the Kenyan investing populace. You have a thriving pension market. The pension market should not significantly go to government. Yes, they should invest in government securities because it's a low-risk investment, but there are other sectors that funding can be deployed into to develop the economy. And I think that this is enormous, from infrastructure to the manufacturing sector to the telecoms operator. There are huge opportunities in terms of carrying investing funding from the pension into the sectors. And I think that's the way to go to grow any economy. In terms of looking at the banking sector, one of our, in reviewing the sector, was to notice that the NPL ratio was about 13.9%, and that's not good. It's not good on a sustainable basis. Even though today the capital adequacy ratio is quite good and is strong at 19%, but if the asset quality issues are not addressed, what will typically happen is that the banks will need more capital to support their business risk. What we've seen happen in Nigeria is, for instance, is the Central Bank of Nigeria has insisted, like a guidance, that every bank must have an NPL ratio no more than 5%. Now, if your NPL ratio is more than 5%, between 5 and 10%, and your minimum capital adequacy ratio is just what you've met. So, for instance, for an international bank, 15%, for a national bank, 10%. If what you have is your minimum, then you'll be stopped from giving dividend. And what this does is that the board of the banks now become heavily interested in how to address the asset quality issue. So everybody now realizes, especially the shareholders, that if no dividend is being paid, the dividend is not being paid because our NPL ratio is high. How can we address this? So in the end, this is good for the system. We need to bring down the NPL ratio. And it's not only by growing the loans, it's by growing the loans in a risk-adjusted manner, whereby the right pricing is in place for the risk, and therefore the banks are adequately aware on the kind of risk they want in their book. So this needs to be done. One of the things we've encountered in Nigeria is that we've had banking failures. But one of the things that the central bank has done to forestall banking failures is that when they realize a bank is going through a financial distress, or what we call distress, what the CBN does is to intervene, bring in additional capital to be able to bring back the capital ratio to a reasonable level, and also change the management of the institution. And the reason being is that the management are the ones really at the forefront of driving an institution. The credit risk appetite of an institution is driven by the board and the management of that institution. And whenever they see that there is a problem, to forestall a systemic risk, what the central bank does is to bring in additional capital and then to change the management. And I think these are the kind of initiatives, from the NPL ratio guidance to changing the management and recapitalizing institutions, that the Kenyan banking industry can also embrace.